This is the In Focus podcast from The Hindu.
Hello and welcome to the In Focus podcast. I am Nivedita V. The Indian rupee is on a downward trend. It logged its fifth straight monthly fall in Feb, fell 1% in February and slipped to an all-time low of 87.95 during the month. Persistent outflows from the stock market have also hit the rupee hard. Foreign investors have net sold over $14 billion worth of Indian stocks so far in 2025, and this has played a major role in making the rupee one of Asia's worst performing currencies. The RBI has the mandate to address this volatility. It has intervened in the market periodically to slow down the slide. It has many tools to do so. On the 20th of February, it exercised one such tool. The RBI conducted a dollar-rupee buy-sell swap auction of $10 billion for a tenure of 3 years. The auction was oversubscribed. A Reuters poll suggests that analysts expect the rupee to weaken further to 87.63 in the coming months. The poll suggests that the sluggish economic growth, uncertainty over US President Donald Trump's tariff plans, and the rising possibility of a global trade war have hit the foreign investors' demand for Indian financial assets. So, what can we expect the RBI to do? How does the RBI decide to even intervene in the market? How is this sport of volatility different from the volatile periods we've seen before? And what is the greater impact of this volatility on our economy? I have with me Smita Trivedi, Associate Professor, National Institute of Bank Management in Pune, to help understand the matter further. Ma'am, thank you so much for joining us today.
Hi, I'm glad to be here. Thank you so much for having me.
So, Professor, the Indian rupee has not had a great few months. The rupee has fallen for the fifth straight month in February, and experts say that it is weighed by foreign portfolio outflows, meaning that foreign portfolio investors are exiting the Indian markets and they are selling the rupee. Why is the rupee so volatile now?
Yeah, that's, I think, the perfect question to start with. Rupee has had a very sharp movement in the recent past. And last 5 trading days, if we see, it's moved from 86.6 to around 87.2, stands at 87.3 to around as we talk today, which is around a 50% move. And if we are seeing the intraday trading range, there has been anything between a 30 to 50% move. Both the depreciation and volatility, as you have rightly pointed out, is high compared to what we saw in 2023 and 2024. This is definitely both a bigger move and a sharper move. I mean, just to bring a bit of comparison and to drive this point home, if we look at the entire third quarter of 2024-25, August to the beginning of November, rupee just moved around 40 paise. So it was 83.7 to 84.1 around. And from December onwards, we have seen the rupee movement being sharp. Uh, the reason I put it in the context of the earlier move is also it appears now very volatile, but and of course, as you again pointed out, the one of the main key reasons is the FII outflows, but it's also closely linked to the dollar strengthening. The geopolitical situation, of course, has become very chaotic in the recent past, and the fear of trade wars are escalating. So the investors are moving to dollars, and dollars has strengthened. Dollar has strengthened for some time now. So from end September last year to now, the dollar index move itself, the dollar index sees dollars with respect to a basket of currencies. It has been around 100 to 110 around Jan 2025, corrected to 106 levels now. So the depreciation that we see in rupee is very closely linked to the developments outside of India rather than to the domestic scenario. And again, the immediate term movement in rupee, if we see, it is very important to differentiate a bit between what right now is happening to what was happening in 2023, 2024. We had a lot of stability, but now the geopolitical situation, now the global risks are different. And it is also a good time to focus not on the short term factors but a little bit longer term and the immediate term movement. If we see, that's a better perspective on rupee. So if I may clarify myself over here, if barring the last 3 months, rupee has in fact been very stable. If we see the last 2 years, rupee has been one of the most stable currencies. If we do a peer group comparison, again, it has been very stable. And right now, it's very important that we focus also on the inflationary headwinds, because that might impact rupee more and more of over the longer term than the present short term movement. So exporters are dependent on imports to a smaller and greater extent in the Indian scenario. A depreciation is therefore harmful for both exporters and importers. And if we are looking at a longer term scenario, that puts the perspective well, because the firms know that they have to hedge their exposures properly. We are also looking at factors which go beyond the very volatile FII flows. We are focusing on things which can strengthen the rupee. Intrinsically, we are looking at inflation, we are looking at our growth scenario. So putting the longer term perspective is, I think, very important now, because right now, as the more the short term volatility happens, we tend to get very very moved by whatever is happening around us. So it seems, yes, there is this kind of FII outflow, the geopolitical situation, the movement in rupee. Why is it so volatile? But again, it's over a medium term. And if we see the last 2 years, rupee has been fairly stable. So I think the shorter term volatility that we see need not really worry us so much. That is what I feel. And if mm, if I have to put it, I think I would focus more on the inflationary situation that was there. And once that is checked, fundamentally rupee would be in a better position.
So while talking about the rupee versus dollar, we also see that the rupee is not that badly performing when compared to other Asian currencies. What is happening here?
Yeah, absolutely. I think this is a very good context to put it. So you are absolutely right. If we compare to the peer group nations, in fact, if we take all three periods post COVID to around June 2022, June 2022 to end of 2024, and then the present period, even with the sharp movement that we see now, rupee has performed in the peer group better. The volatility is amongst the least, and it's much more stable than most currencies. Of course, if we see especially the last 2 years, rupee has been quite stable. And what's happening, so as you said, what's happening over here is also the fact that right now the inflationary situation is much under control than we see some time back. And a little bit of explanation maybe in due here. So when we are looking at a currency value, of course, currency is kind of a two-way street. So it's one currency against the other. And the fundamental value, therefore, is very much linked to inflation, because if the purchasing power of your currency falls, if you have inflation, then the value of your currency against another currency is bound to fall. And over a longer term, inflation has a very very strong impact on any currency's value. And fundamentally, that's very important. Growth is important, interest rate differential is important, but inflation, so if we see when the inflation headwinds were very strong, that is where again there is a greater fear, because that is in any ways going to depreciate rupee. So inflation leads to depreciation, and depreciation in turn make your imports costly. That can fuel further inflation. And if there is one variable that I would keep an eye on for the long term strength, is how stable the prices are in a country. And I think the same kind of signals are also coming from the central bank. So this time in the NPC statement, the governor has clearly said that we are not looking at day to day kind of volatility. That's a perfect signal, I think, right now for the markets, that it is more of the longer term that is being seen by the central bank and not the very short term volatility. Again, that brings the focus to other economic variables which can impact the rupee intrinsic value. And if you see historically also, this kinds of makes sense.
Okay. So you're talking about medium term and long term variables that we need to consider. Medium term and short term will be the inflation. What about longer term variables that we need to consider?
So, if I may just clarify a bit here, over the medium term and the long term, inflation is a very big factor. Shorter terms, it is more of the capital flows, especially now. Again, the FII capital flows are reacting to the geopolitical situation, so those are important. And over the longer term, again, other factors which are important. Of course, the growth scenario in the country is very important because if the currency has to be intrinsically strong, investors need faith in the economy. So instead of FII, if I look at FDI flows, longer term investment, again, that is possible to attract when the economy is stronger. And so growth is important. And so again, it brings back the story to inflation, because in our country at least, that has been quite a bit of a worry till recently. And for the interest rate scenario, of course, RBI, the policy rates also keep this in mind, and we are in an inflation targeting framework. So that's one of the key variables that we are looking at. So if on the longer term, if we have to look at the variables, the inflation picture would be very important. The policy rates, of course, and that is again linked to the inflation growth scenario, and how the growth scenario pans out, how investors think your country is going to perform. That's very important. Over the very short term, of course, the current situation is, it's more of the global factors impacting us, but political uncertainty within the country or outside, in any cases, will impact the shorter term movement.
This is not the first time the rupee has faced volatility. I remember back
Yes,
in
absolutely.
2013, 12, there was a lot of volatility and there was also high inflation back then. So, what is the difference now? So, other than low inflation, is there any other reason for the rupee to be volatile now?
Yes, I think that's a very good comparison that you have put, and I'll go back a bit if that's that will make the picture clearer. So if we go back to 2013, in fact, that was one of the sharpest period of volatility we have seen, and August 28th, 2013. That's kind of a day you won't forget if you're in the markets. If you opened at 66, at 66.1 or something, and scaled 69.22 in a day, it was around more than 4%. That was the move, and closed at 68.8, I remember. And so that the entire depreciation in a day was very strong. But from May onwards, May 2013, if we see, that was also around more than 20% depreciation in 3 months. It was very, very sharp. And the immediate reason again was global. Federal Reserve chairman had hinted at a tapering of the QE, and because of the weak fundamentals, peer group currency, when we looked at, we performed the worst. So it was the global factor, but it was also the fact that fundamentally we were not doing well. One factor which you immediately pointed out, inflation, actually, that is again one of the most important things. Over the long term, if your currency is being influenced by something, it is the purchasing power that you see within the country. That's very important. And 2013, this was very important. Inflation, we were having sharp inflation. The growth story was not panning out very well. Investors, the political uncertainty, that was not being taken well by the investors. So if I outflows are very usual in that kind of circumstance. So it wasn't very surprising, but it was the fundamental weakness. So if I compare the situation to now, and if we bring back a few more of such episodes, like August 2015, with renminbi devaluation, there was a period of sharp depreciation, demonetization. We had fundamental positions in these times, 2015, 2016, were better compared to 2013. If you look at COVID, again, the uncertainty is very high. That time we had a very sharp depreciation, and that is expected because, again, fundamental factors during such a period of very sharp uncertainty is very, very difficult to understand, and there would be a lot of speculation against a currency. If you see 2022, I think that in the recent past is very important because around Jan 2022, we were around rupee was somewhere around 73. From there, by October 2022, we had gone to 82. So that is where again the picture of inflation comes in, because that is the time where we were having a sustained inflation headwinds were very strong, and I mean all the sectors, food and the general, were showing this inflationary trend. So I think the situation now, if I can put in comparison with all of these episodes, 2013 and 2022, it is better because the economic variables look better. And especially, I think inflation will be a key variable. Once those headwinds are controlled domestically, there will be a stronger faith in the currency, and we really need to focus on the domestic fundamentals that can make rupee strong.
So the RBI is the one which controls, manages. The manages is the word now, isn't it? Manages how the exchange rate between the rupee and other currencies of the world. Um, what are some of the tools that it has in its hands to ensure the rupee doesn't fall too much or also gain too much when compared to other currencies?
So again, to bring the signal from RBI as the market receives it, RBI very strongly states that it will intervene if there is too much volatility in the forex market. And we call ourselves a managed float, but in the recent past, there has been very strong signals from both the central bank and the government that rupee would be linked to the market value. It will be more market determined. So the again the focus is on volatility, never on the rate. So that part from the central bank, there's a very consistent signal over the years, and that has remained unchanging, that RBI is going to look at volatility, not at a rate. And therefore, the tools it has to use are also manifold, because first of all, there are lots of tools, but I'll start with the signals. See, the first thing that is coming is that as market participants also, we receive this very strong signal from the central bank that I'm there for volatility, but I'm not going to control the rate. And right now, the governor's statement clearly puts the emphasis on long-term factors. So the signal is very clear that they are not going to look at very short-term day-to-day volatility. The signal is clear that volatility would be taken care of. It is too much volatility is always a peer group comparison, because otherwise you cannot say. And of course, the comparison of the currency over its time. So that signal is very important. It's very, very crucial here to be consistent, and mm, Reserve Bank of India has been very consistent on that. They do have other tools also, which are again used quite a bit. So there is intervention on the spot market, on the forward market, and along with that, there are also other kinds of interventions that can be done. So, for example, if capital flows are encouraged and measures are taken for that, if there are measures to curb imports, to strengthen exports, all of that can impact rupee, can help rupee. So just to make this point a little bit more clearer, if we go back to 2013, because we mentioned that, and it's useful to sort of bring that comparison. There, RBI had made use of all these very innovative policies, and those were very helpful. So 80-20 scheme was brought in, and then the especially dollars swap window for the PSU oil companies were brought in to attract capital flows. FCNRB deposits were encouraged. So all these measures, the indirect kind of measures, are also very crucial. That said, the focus majorly when we look at the market, it's more on the spot and forward market intervention. But I also wanted to highlight that along with the spot and forward market intervention, all these indirect measures in which the central bank can impact the value of the currency, including the signals it sends, because market participants look at the central bank for these signals. Those are very crucial because that can guide the market, that can show that there is strength in the currency. And spot and forward market, of course, that uh, what we have seen is
That's direct
it has,
intervention, right? So,
yeah, that has been consistently used. And if you see the post pandemic intervention data, now we have a lot of focus on the forward market interventions, because a spot market, of course, suppose there's a depreciation and I sell dollars, I means the central bank through the PSUs, they're selling dollars, then obviously there will be a liquidity crunch. So forward market interventions help to take care of those repercussions on the domestic side, and therefore forward market has been used very effectively by RBI. So if we the entire post pandemic data we have been monitoring and we are seeing, so we see both spot and forward, but the fact that forward market interventions has been used quite effectively. So after the pandemic, there the key things which comes in terms of the central bank intervention is that both appreciating and depreciating phases have been used, and volatility has been looked at in both those phases. It's not only depreciating spells that the central bank has kept their eye on. The spells where rupee has been appreciating a bit is always used to also build up kind of reserves. That's very important. And mode of intervention has been again quite a bit on the forward side, which impacts the premiums, gives a forward guidance on rupee. And forward market, as we said, can be a very effective tool. And this time also we are seeing that for the liquidity, the currency swaps are being used, which is again kind of the right direction.
so talking about currency swap, one happened on the 28th of February, which is just recently over the weekend. What exactly is it? And people say that it's supposed to help liquidity. How will it do that?
Yeah, so currency swap is where RBI is going to buy dollars from banks in exchange for rupee, and the obligation is to sell those dollars back at a later date. So uh, currency is always a two-way street. Anything I do on the dollar side comes to the rupee side on the other way around. So it can be an effective tool. It's also something which has to be used cautiously, and it is also a very innovative way in which these tools can be used. For example, we may think that intervention may be used only to look at the value of the currency in terms of dollars. But as you see here the aim has been the liquidity infusion. So we have seen that liquidity crunch has been there in the banking sector. There were very strong signals from the banking sector about the liquidity needs. And RBI carrying on the liquidity infusion now also shows that the domestic concerns are being given a priority, instead of just looking at how the exchange rate is panning out, the dollar value is panning out. So I think that's very 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 important, especially because Fed has decided to keep in Jan 2025 the rates steady. So if there is no rate cut, I think on the domestic side, the liquidity is something which the central bank is going to look very closely on. If we are having another rate cut, then of course, again, with that, the liquidity measures will be used. If not, then also I feel the liquidity measures would still be used. So the currency swap was very rightly placed to put the liquidity in the market. And as I said, if we see the forward market intervention, it uses the same principle that whenever we have only the spot market intervention, there's immediately a repercussion on the rupee, and the forward market takes care of that. So the currency swap here has been used more from the point of view of what was the domestic market concern, rather than just looking at the exchange rate, which I think is a very good signal to the market as well, that that's the priority.
Okay, so if I'm getting it right, the RBI bought dollars from Indian banks and other corporates and said, "Here are rupees at a premium." Right? They bought at a premium dollars and gave rupees and said, "Here it is. Go and here you have more liquidity. Go and give loans to the people." Right? So it's more of an inward-looking thing, more than a
Yes. Yes. So once again, so if what happens is, the liquidity crunch, if we see that, may impact the credit that goes to the different sectors. So when RBI buys dollars from the bank, there is, so the removal of dollars from the market means rupee goes in. Because again, it's a two-way process. So the moment I buy dollars, I sell rupees. So the selling rupees is important, but again, it's a swap, so there is an obligation to sell those dollars back at a later date. And selling dollars back at a later date also is very crucial, because what happens is, you have kept a space. Selling dollars always lead to your currency being stronger, so you have kept a space for that. So that you are perfectly right. That was the main focus, that the Indian banks, and especially because there was a need felt that the liquidity was crunched and there was a problem on the liquidity. Indian banks should have adequate liquidity to pass it on to the different sectors, and credit should not suffer. The idea is that it should lead to growth. So if I here point out, I think while that is what the central bank can do from the policy rate perspective, from the from these kind of actions, the liquidity perspective, currency swaps and other things, the central bank is trying to provide adequate liquidity, as well as to keep the policy rate in a way so that the credit needs are met. But it is something that we as an economy have to remember, that the RBI's action cannot go further and cannot ensure growth unless the other things take place. So the variables that are there with the central bank are these. And of course, credit can grow. Credit is growing to the different sectors. But after that, after the credit growth, to economic growth, these sectors also adding value, there is still a gap. And I think there has to be a focus on other things, like whether the firms are investing enough in their capital needs over the long term, whether the adequate demand is there, whether consumption expenditure is happening properly, because that creates demand, and then the firms are willing to spend, then they are motivated to spend in long term capital accumulation. I think the capital formation is going to be crucial, and the manufacturing sector, if it has to grow, it's not simply the credit. After that, the enabling factors should be there. Government has been spending a lot on infrastructure. The private capex, not so much. So those are things in the economy that also needs to be taken care of, so that finally, from the policy rate to credit to economic growth, the entire thing happens. Otherwise, per se, credit growing to different sectors alone cannot ensure that all those sectors also contribute. There are a lot of factors, and the skill development, the kind of people we employ, that's also going to be very important. And I think these are the things that, as I said, the domestic market concerns, domestic market factors should be brought into focus, and more focus on those, because finally, when we are not looking at the shorter term, the firms who are engaged in exports and imports also get a right picture. They realize that I cannot speculate on the trajectory of rupee. I have to take care of my exposures. They hedge properly. So that is one of the concern, that if they feel that rupee will be in a certain range, they may not hedge their exposures correctly, which can be very detrimental to the growth of
Meaning,
these
so
firms.
what does that mean? They won't hedge correctly. So what does that mean?
Yeah, so what it means is, so we have exporters and importers whose obligations are not very short term. So in 3 months, they are going to receive dollars, or they have to make payments of dollars in 6 months, in 1 year. These are over a period of time it pans out, these obligations. So suppose I speculate today on the value of the currency, and I do not make provisions to ensure that a particular rate is locked in. And when I say hedge, I mean use of forwards to lock in that rate. So if I am an importer, especially, and rupee secularly has been depreciating, I would, I should hedge my exposure, because in 3 months or 6 months I should not speculate on the rate, but the forward rate that I'm getting today. I can compare and I can lock in whatever the exposures I'm having. I can cover my exposure. That's very important. So the hedging is also very important from the firm's point of view. So forward allows you. There are two kinds of markets we are talking about: the spot and the forward. So the spot is, of course, the rate for today, and the forward is again the rate being given to you today, but the the transaction is going to happen at a specified time in the future. So 1 month, 3 months, 6 months, whatever is the time. It makes sense for these firms to try and lock in those rates, so that I know that these are my exposures and I covered them, rather than keeping it open, which means that as rupee depreciates or appreciates, whatever it is, my entire flows will be very volatile. It will be just left out to whatever the movement rupee has, which for the real sector can be detrimental. So I think the signal that the firms should also take is, in any such period, currencies will move in tune with the markets. It is should not be and cannot be possible to control currencies. We are, of course, a currency cannot move in a line or in a range. So the proper thing for corporates and firms is to see their exposures, hedge them correctly, and not speculate on rupee movement, say 3 months down the line or 6 months down the line. So that's
Okay.
also
So that's basically to protect themselves. So especially if you're an importer, to protect yourself,
yes,
saying, okay, so it might
yes.
fall even more. So I have to keep a certain amount of money in the hand so I can pay off whoever I'm paying off.
Not only keep a certain, you lock in the rate today. So when you're taking a forward,
Okay.
you are
Okay.
locking the rate today. You
Hmm.
are, so rupee may go to XYZ tomorrow or 6 months down the line, but the rate I get today, I know exactly this is my exposure. So 6 months down the line, if $100 I have to pay and I get the rate at Y today, so Y into 100 is fixed for me. For me, that's the exposure. So I am able, with the forward market and with hedging, I'm able to lock in this, rather than just keeping it open to the value of rupee, whatever would come in that spot market. So after 6 months, whatever is the value of rupee, if I today have a forward, then for me it is a better option. It is a covering of my exposure. That's what is important. And of course, from the entire economist point of view also, it's good when exporters and importers, so exporters, of course, they feel if rupee is going to depreciate, then they'll get more for each dollar, so they need not hedge. But most of our exporters are also importers. They would have some import exposures, so it is good when the exposures are being covered.
So how will all of this impact the exporter? You said that they don't have to pay. They will get more rupees. Sorry. They'll get more dollars in,
For each
but
dollar, they get more rupees if
yeah,
rupee
more rupees.
depreciates.
Yeah. So,
Yes.
how, is that a net benefit for India? Then should India just let the rupee depreciate?
Well, again, it brings back the question to whether just the export competitiveness is important. And of course, RBI has not looked at rupee that way. They have not targeted any rate in any of the terms. But if you see it from the perspective of countries which has tried to do that, kept the currency competitive for exports, it doesn't really work out very well in the long term. Again, as we said, exporters are also importers. So the rupee depreciates, they pay higher on the imports that are happening, especially on capital goods, on fuel, and then again, they are not competitive enough in the global market. So rupee depreciation, exporters, tend to, of course, the normal tendency as an exporter that I'll have is if there's a depreciation, why to hedge? Because I am going to get for each dollar more rupees. But depreciation need not be good for exporters. While in the immediate term, if we think the price of my commodities will be competitive in the global market, but if I pay higher on the exports, if I have, if I import the inflation inside, so the one of the problems is currency depreciates means you also pay a higher cost for imports, and that feeds your inflation. So overall, as an exporter, I would not think that a sharply depreciating currency is good for me, because the rest of the factors which make my goods competitive will be adversely impacted. So for I will get for each dollar more rupees, my goods can be for a short term a little bit competitive in the market. But overall, if I look at my production process, if I look at my imports, and the stability of that entire thing, then we need a stable currency. As long as we have inflation, we cannot really stop the long term depreciation. But if inflation is stable, the currency will be stable. That's the and that will serve both exporters and importers well, and the rest of the country, like the rest of the market participants as well. So this is very important, because rupee movement, it impacts a certain segment. When we talk of the short term movement, of course the traders are impacted, day to day volatility. But volatility is in the trader's playbook. I mean, as a trader, you are trained to handle volatility, to also earn profits from that volatility. But that is something, while that is something okay for the trader, for the exporter and importer, it is more, the day-to-day volatility is not should not be that much of a concern, as much as in the medium term, in the longer term, how the currency is stable, or how the intrinsic strength is of the currency.
So all this time we've been talking about how the RBI can manage the exchange rate and some of the tools that it has to do so. So some believe a policy question here is that the RBI should be more flexible when it comes to the rupee and it should let it slide. So when does the RBI or how does the RBI decide when to intervene and when to stay put when it comes to the economy? What are some of the factors that are involved when it comes to rupee depreciation and appreciation as the case may be?
Okay, so of course it may not be possible to really speculate on what would be the reaction function of the central bank and what are the factors which make them intervene. But that's it. Of course, yes, there's a lot of criticism that has come earlier in 2023 from the IMF, that rupee was moving within a very narrow range. But Reserve Bank of India has also very consistently stated that it is going to look at excessive volatility and not the value of the currency. And I think so the view that RBI should just allow the rupee to be maybe a little bit difficult for a country like ours, because as we said, if there's a very very sharp depreciation over a term, then there are segments in the economy that is getting impacted, and one of the things is with the import cost is the domestic inflation again, uh, facing, and that can be a concern. So I think some the way RBI is right now looking at curbing excessive volatility is the right stance. I mean, we cannot have a scenario where we just let the rupee slide. Uh, that's it again. Now that the economy is also strengthening, rupee is also adulting. So striking the right balance between allowing the rupee to be driven by the market and curbing the volatility is a tough job which the central bank has. The good factor is that the signal on volatility has been quite consistent, and on the rupee value, the look at the longer term, the focus away from the very short term to the longer term, I feel is the right way, and that I feel is going to be also giving a signal to the market participants. That's how they are they should be also looking at the rupee value. So as I said, for the different segments of the of the people, the market participants, the traders, they of course they face the volatility, but they should be able to handle it. They are trained to handle it. That also applies to the other markets. But for the longer term, when we look at equity market, whether it's the investor or when we look at the currency market, whether the firms we are looking at, there it is a more a focus on the factors which will impact the fundamental value. There, there would be a lot of need to again look at the how the scenario in the country in terms of what kind of investment direction we are going in, how is the growth featuring, how is the skill formation happening, how is the human capital being developed. Those can be over a longer term much more important things. So that is uh, again a focus back to the domestic side rather than right now what is happening globally.
Okay, so the RBI tends to look more at domestic factors than external factors because obviously it can't control the external factors. Is that a right way to take this?
Yeah, I think RBI, again, while we do not know what exactly would make the central bank one day step into the market and intervene, we can think of certain factors which will be important. For example, peer group is a very good comparison. If when you're looking at the peer group comparison, you understand whether it's just the global factors driving your currency, or there is, inside also there is something. So that's a good way to look at it. And usually in the market also we look at those comparisons. And yes, as you said, the focus on intrinsically what is happening. So if the inflation story inside is that there are very strong headwinds, then again it is going to impact the currency. So this side it would be very important to look at the inflation targeting regime and to see that the inflation is controlled. What I feel is, again, when the central bank would intervene, or what are the factors which will make the central bank intervene? There are, of course, the global factors impact rupee. If there's a very strong volatility, there will be some intervention to curb the volatility. Uh, but again, there also the overall picture, that whether it's a very short term move, whether it's a very particular kind of uncertainty, or a more sustained factor, that can be an important a good way to see this. And again, while we do not know what in a day would make the central bank come to the market, overall all these conditions are important. What is happening to peer group, of course, global factors, but more on what inside the country is also happening, and to see globally also, to look at the factors in terms of whether it's a short term uncertainty or it's going to be a sustained factor going forward. So trade is something where we have a lot of concern now. The tariff wars, and there those kind of things over long term can have a lot of impact. So there we have to kind of think of our policy kit, think of what can be done going forward, so that even with the uncertain global scenario, we still can think of rupee which is more in tune with our internal story.
Thank you so much for explaining to us, Dr. Trivedi, what is happening to the rupee and why it is so volatile.
In Focus will be back soon with analysis of the biggest news issues. In the meantime, you can find our podcast on Spotify, Apple Podcasts, Stitcher, and other platforms. Just search for In Focus by The Hindu. We'll see you soon.